15 Principles Investing Elites Use. According to Warren Buffett, when the economy weakens, the true investors are revealed, and only then do investors have applied the core principles of investing see success. In a strong economy, it is easy to become complacent and neglect caution. During such times, most investment options perform well, and investors typically earn positive returns. However, during an economic crisis, it is only crucial to apply these core principles of investing, which are highly important, but only known by a select few elite investors. Now is an excellent time to learn how to invest. So today, we will be looking at 15 principles that investing elites use and how they can help you too. Welcome to Prima Invest, where we will give you information relating to all things investing. Let's get to the video. Enjoy. Financial plan. Having a thorough grasp of your existing financial status is the most important and fundamental rule when developing a financial strategy. This is the essential stage you must start with, whether you are handling it yourself or working with a professional. You must keep in mind to always be truthful when doing this. You must be as honest and transparent as you can, even though it may sound cliche. There is no assurance that you will get your money back, but the likelihood of success is enhanced if you develop a clear strategy. Invest early. According to research, starting your investments early is more beneficial than waiting until you have a sizable sum of money to invest. Start with what you have, and add to your portfolio over time. When you start investing early, you can take advantage of compounding interest, which is when you use money you already have to make additional money. As a result, you profit from both your initial investment and the interest and dividends that have accrued over time. Even a 2-year delay in making your investment could cost you thousands of dollars. Diversification. Diversification is a skill that successful investors and wealth managers have mastered. Even though it may seem like basic sense, the idea of not placing all of your eggs in one basket is a wise one to follow. The idea of diversification is to invest in several distinct possibilities rather than just one. Loss risk is lowered as a result. You could lose a lot of money, for instance, if you only invest in one business and it goes bankrupt. You can reduce your losses by diversifying. While diversifying, it's crucial to choose a wide range of investments from various asset classes because they tend to rise and fall at various rates. This way, if one investment doesn't perform well, another may still provide a positive return. Leverage. Using resources beyond what you already have is crucial if you want to amass big riches. This can take various forms, such as financial leverage, which entails utilizing other people's money to enhance the amount of money available for investment. As there are only so many hours in a day, time leverage refers to using other people's time to accomplish more. Using the knowledge of others in order to gain access to their specialized knowledge is known as knowledge leverage. Leveraging other people's established systems that are more effective and efficient is referred to as using systems and technology. Don't be scammed. Scammers are everywhere, and they are constantly seeking their next victim. Don't be one of them. These con artists frequently leverage widely covered news stories to entice investors. They frequently offer opportunities that are too good to be true. What can you do? Ask as many questions as you can to avoid becoming a victim, and make a formal document request. Include a lawyer in the process of evaluating the entities before investing. Cash is king. The pandemic has, if anything, highlighted the value of having a cash reserve. Make sure you have a cash reserve before forming any financial plans. The reserve should cover expenses for 3 to 6 months. To get an idea of how much money you spend each month, start by writing down all of your costs along with the quantities. The folks who had savings when the pandemic first struck were probably less impacted by the economic crisis. We have no control over economic developments, but we do have control over our emergency finances. The reserves allowed them to sail through the harsh waters unharmed. Make sure you have the money saved up in a secure location in case anything unexpected happens. Be careful when using debt. Debt has both positive and negative aspects, advisors say. It does indeed have both benefits and drawbacks. Time frame. Before putting together an investment portfolio, it's critical to comprehend your time horizon. You may maintain perspective in choppy market situations by being aware of this. A long-term investor, for instance, does not fear a bad market. In fact, it offers a fantastic chance to trade at lower prices and earn profitable returns over time. Learn how developing a strong investing strategy is aided by being aware of your time constraints. Building a portfolio without knowing when you will need the money is really unwise. I want to know, are you investing for the short term or the long term? Let me know in the comments below. Dollar cost averaging. This refers to the practice of routinely funding investments at predetermined times. Lessen your urge to the time market and gradually accumulate wealth. Rebalancing. The buy low and sell high principle serves as the foundation for rebalancing. To benefit from the changes, it entails changing the weights of the assets inside a portfolio. By using this technique, you can simultaneously buy positions whose values decreased and sell positions whose values climb. This makes it possible to maintain the initial asset allocation in accordance with the risk tolerance of the portfolio holder. The importance of conservative bonds. Many investors ignore reliable fixed income sources when the markets are booming. High-flying technology stocks are in strong demand. There's nothing wrong with that, so don't worry. But in truth, turbulence frequently appears when the market is performing well. Yeah, you will have some returns, but how long until a decline? Bonds have a role in this. Bonds are essential to portfolios for many reasons. They act as a buffer for volatile markets by allowing investors to sell an asset without seeing its value fall. And it is short-sighted to disregard bonds as a primary investment strategy. Risk and return relationship. Every investor out there is diligently looking for the choice that offers the biggest return with the lowest risk. Striking the right balance is difficult because the danger of losing an investment increases as promised returns increase. Danger could manifest in various ways. Illiquidity, bad credit, or leverage are all possible causes. The inability to quickly turn an asset into cash is referred to as illiquidity. The state of the economy is also quite unstable and is a major factor in determining the rate of return. Hence, while you invest, keep in mind that every lucrative opportunity has a high degree of risk. Boring is better than exciting. People enjoy exciting things, and they frequently choose the next greatest product available. Between an exciting chance and a real opportunity, though, there is a fine line, and most people miss it. Most investors make an intriguing concept for a wise choice of investments. As you will see, this excitement is frequently wrapped up in the newest craze, a revolutionary new company strategy, cutting-edge technology, or even a special offer. Most people concentrate on the buzz rather than the basics. Keep in mind what we said before about allowing feelings to influence financial choices. Perhaps you now get the idea. Stick to dull, conventional investments to avoid being seduced like a toddler by candy. These might be high-grade bonds, blue-chip stocks, or index funds. Although you could miss out on the upcoming hot IPO, you won't miss out on consistent gains. Be alert to taxes and fees. Before choosing a broker, make sure you compare their commissions, as they differ. Also, capital gains tax may lower your overall earnings. Examine the laws in your jurisdiction before investing to learn what taxes are owed on your winnings. Hey, if you enjoy this type of content, do give us a like and subscribe. Don't be addicted to the stock market. Addiction to the stock market exists. A common comparison is with gambling. If you start earning well, you'll constantly desire to increase your income. But once you have amassed a sizable profit from the stock market, you should consider selling to avoid sharp market declines and the anxiety that comes with waiting out bad markets. You see, even though they may not offer returns as attractive as those offered by the stock market, you may always look for other investment opportunities with reliable returns. These are the 15 principles you can use in order to make yourself an elite investor. Thanks for watching. For more videos like this, click the link shown on screen. Remember to give us a like and subscribe to our channel. And as always, have a good one.